Good morning, everyone. Thank you all for coming. My script actually says, thank you for braving the elements, but there's no elements to brave. Everything is fine. Welcome. For those of you that did brave the elephants, you're in for a special conversation this morning. We have quite a few new attendees, first-time folks to the Roundtable. Welcome. If you like what you see, like what you hear, you can see myself or Heather Johnson about Roundtable memberships. We'd be happy to talk to you about that. Before I turn things over to Dr. Painter, as always, I want to thank our sponsors for many, many years, our longstanding premier partner, PNC Bank, our platinum partner, Eagle Realty Group, our gold partners, Brandy Corp, Hills Properties, Kroger, Nair Properties, and North American Properties. And as always, to our 60-plus Bear Board members whose smiling faces you've been seeing on the side panels here all morning. Thanks to them for all that they do. And finally, to our Roundtable sponsors, 5 strong. That is all I have. I'm going to get out of the way and let the real conversation to begin. And to do that, I want to bring up to the stage our academic director, our Baer Chair Professor of Real Estate, Dr. Gary Painter.
Very much. I'm really excited to be here, and I'll go ahead and invite you up as I introduce you. You know, this is really exciting to have our president here with us today, our Beth Hammack, and I'm going to just give you a little brief bio. I know we have a lot of students in the room who are finance majors and real estate majors, so you'll really appreciate her background. I also wanted to thank our president for wearing UC colors today. You know, so really, with all the decor, how could you not, right? How could you not? But her background, she's only relatively recently come to the Fed, so it was about, 15, 16 months ago, to join as the president and chief executive officer of the Cleveland Fed. And so that means she's responsible for all the things, all the activities, which is related to monetary policy, which we'll talk a little bit about since there was an actual vote 2 days ago. Bank supervision, payment systems, the nitty-gritty to the high-level monetary policy. She worked in New York for over 30 years in finance and capital markets, risk management. Most recently, she was at Goldman Sachs and leading co-leading their global finance. But I also like the fact that she goes beyond that. She's worked with U.S. policymakers at the Treasury. She is the chair of the board for the nonprofit Math for America and is also a member of the City Harvest Board of Trustees. So we appreciate your vast engagement. I know bios are uncomfortable, but I'm happy to share it because I wanted to share with everyone here what all you do. Now, as a new Fed president, we had the privilege of hosting Raphael Bostic, who was a longtime colleague of mine, and I remember when he started as Fed president, he was touring the whole region for the Atlanta Fed. And so I wondered if you could share a little bit about what your first 15, 16 months have been like in terms of getting to know the region and then how that informs what you do in your job.
Yeah, well, thanks so much for having me. This is such a great venue, and what a beautiful setup to be able to participate in. And I do love the UC colors everywhere. It feels a little bit holiday too, but it totally works. So as a Fed president, part of my job is to represent the region, and the Cleveland Bank is responsible for what we call the 4th District, which covers all of Ohio, Western Pennsylvania, Eastern Kentucky, and the Northern Panhandle of West Virginia. So that's our region. So coming to this region from New York, I had a lot of learning to do. Now, my husband grew up in Cleveland. We have family there. And so they gave me a good inside view as to what's going on in northeastern Ohio, but obviously the region is pretty diverse and there's a lot that goes on. And so for me, being out and traveling around the region is really critical to get the insights as to what's happening on the ground. So I try to come to Cincinnati and Pittsburgh. We have branches in each of those locations at least once a quarter and connect with business leaders. So my day, I got in late Wednesday flew from Washington from the FOMC meeting, spent some time with our team. We had just a kind of happy hour. Yesterday, had a breakfast with a local business leader, met with a different, I guess I had 2 different meetings with business leaders, Did some more time with the team, events like this to connect with people. We'll have a roundtable lunch later today, some more one-on-ones. When it's winter and colder, they usually send me on tours of businesses that are indoors. Okay. The last time I was here in June, or I guess I was here in September as well, but when I was here in June, we did a really nice tour going around the On the Rhine district. And so learning about the rehabilitation that had happened there, we got to stop in at Grader's, which is always something you have to do in Cincinnati, and got to see a local bar and and some restaurants and just sort of understand kind of what's going on in the region. And so for me, those conversations with the business leaders, whether it was the Grader's family, the woman who owns the bar, the gentleman who owned Thunderdome restaurants, it was really just hearing how are they approaching their business? How are they thinking about planning? How are they thinking about their input costs? How are they thinking about hiring? Is it easier or harder to find talent right now? And all of that is great insights for me in helping to make the data, the national data and the regional data come alive. And I bring those stories and anecdotes to the FOMC meetings in Washington to help convey what everyone in the district is feeling and thinking about.
Well, our bankers in the room probably have a good sense that there is a Cincinnati branch of the Cleveland Fed. Not everybody does, and I see your team is here, some of them from Cincinnati, some in Columbus, et cetera. What does the branch here do, and how can we collectively, if we're not being supervised, connect with the Cincinnati branch of the Cleveland Fed?
Yeah, so we have, so as you referenced, the Fed does more than just monetary policy, though that is what most people know us for. We do set interest rates, and that's a critical component of the job, but we have 4 other functions that tie into that. One is financial stability, so looking across the landscape to see if there are fragilities or potential vulnerabilities in the system, and making sure that we're helping to set policies, whether it's regulatory policy that's set by the board in DC or other facilities to help ensure that things are stable in normal times, but also if there is some sort of a problem, like during the pandemic when it was clear that there was much more need for cash, we have the tools to put in place emergency facilities as well. So that's our financial stability responsibility. Closely related is supervising and regulating the banks. So understanding that we have a strong banking system allows credit to be flowing to households and businesses, which enables them to grow and to borrow and grow and invest in their companies. So making sure that we've got a banking system that's strong and stable, which I have good confidence it is right now, but that's
good to hear.
That's an ongoing responsibility. Another one is consumer protection and community development. So spending time to get to know not just the businesses in the region, but also different community organizations. Again, our mission is to help make sure we have an economy that works for everyone. And so that means all up and down the income spectrum. So talking to large companies, small companies, individuals, people who are struggling, understanding how they're putting together. And then the last one is running the payment system. So whether it's the Fed wire, if you're making bank-to-bank transfers, if it's clearing checks through ACH, whether it's issuing Fed notes, which most of you would think of as just cash, the paper bills that you have in your wallet. We're responsible for all of that. And so within our Cincinnati branch, we do have a very large cash operation. So we have a vault where we keep a fair amount of money in the basement, and the banks will send the cash into us from various locations. We'll credit their accounts, we'll check it to make sure it's fit currency, and then save it and distribute it back out as it gets ordered. We also have a number of supervisors who sit in our Cincinnati branch who spend time getting to know all the banks in the region, getting their perspective. And then we've got professionals who are in our regional economics and community development teams whose job is to really connect with local businesses and community organizations, so we get a good picture of what's happening here.
Wonderful. Well, it seems like the Fed is often in the news, but of course a week like this, when you actually have an FOMC meeting, it's even more in the news. Is there anything that you can do to take us behind the veil and talk about the deliberations that happen as you're trying to fulfill the dual mandate of the Fed?
Sure. So I'll give you a little bit of a look behind the scenes as to what happens in a meeting. And really the process starts about a week, maybe 10 days before the meeting actually happens. So the Friday after Thanksgiving was when our blackout period started at Friday night. And when that happens, the team in DC releases what we call the Teal Book. The Teal Book used to be a paper book with a teal cover. Now it's electronic, but it does have teal blue banners in various places. But what it is basically it's the Washington staff's forecast for the economy. It's very detailed. It's about 150 pages with lots of charts and graphs, lots of different analysis. And it gives you a really thorough look at how the economy is shaping up, how we think it's going to project. Because the job in setting monetary policy is not to have a good read on where the economy is today, but on where it's going to be 6 months, 12 months, 18 months from now. Because as we always talk about, monetary policy works with long and variable lags. So that means, like Wayne Gretzky said, you have to know where the puck is going, not where the puck is right now, to make sure that we're setting policy accordingly. So I spend, the time in between meetings, all of these conversations are helpful for me in terms of putting that picture together and what's going on. But then that week before the meeting, I spend in intense meetings with my research staff. So in Cleveland, we have about 70 to 80 PhD economists who help unpack different parts of the economy. We run what's called the Center for Inflation Research. So we have a lot of great data about how the inflation picture is shifting, what some of the different components are, how those are moving around. And so I spend that week before really spending a lot of time with that research staff. I'll do a few listening calls just to hear from different businesses and community leaders about what's going on. But that week is really unpacking the economy. What's the labor market going to do? What's inflation going to do? Right now, we've been in an environment where the labor market has been gradually cooling. You've seen the unemployment rate slowly tick up, but we also have inflation that's been running above our target, closer to 3% than our target of 2% for a long time. We've been missing on our inflation objection for about 5 years. And so trying to balance both those sides of the mandate is really challenging. So then I fly down. So after this week of spending all this time thinking about what we're going to do in the meeting down in DC, we spend some time in that week before. Also, the staff in DC will present the committee with basically 3 sort of options of what we're going to do. So you've got 19 participants sitting around the table. It could be a little bit unwieldy if you were making like last minute word editing decisions in the room. And so what you find is that we'll get 3 options. We'll have an opportunity to comment and send some feedback on the language. This chair, and I'm sure every chair is different, we'll do a round of calls with the 19 or 18 other participants to get their views of how they're thinking about things going into the meeting. And so, he tries to really understand kind of where the consensus is from the group as we head into it. So when we head into the room in DC, I fly down usually on Mondays. The meeting starts early on Tuesday, and you really don't want weather to be a factor in not showing up at the table. So we come in Monday night. Tuesday we start in the morning at around 9 o'clock, usually, give or take. And by the way, all of this is, I'm not giving out any state secrets. We release our transcripts of the meeting with a 5-year delay. So you can see this whole flow of what happens with a 5-year delay if you want to read the 300-page transcripts at any point in time. But the meeting starts out typically with a briefing from the New York desk. So in New York, the New York Bank runs the open market desk, who engages with the markets to really implement monetary policy. So they'll give an update on what they're seeing in money market conditions, what market expectations are, how financial conditions broadly are supporting the economy. We'll have a bit of a back and forth go-round, questions for them, a little bit of discussion. Then the staff who put together that teal book will give us an update both on the domestic economy, the international economy, and some of the monetary policy options. Again, we'll have a go-round and a conversation there. At that point, we usually break for lunch because it is a long day. And then we'll come back together, and all 19 participants will give their viewpoint on where the economy is. So they'll give their assessment. People speak from anywhere from 3 to 10 minutes. I'd say on average it's 4 or 5 minutes of giving some synopsis of how you see both the national and your regional economy. And then we break, and then we go home, you sleep, you think about everything, and then in the morning we get back together on Wednesday at around 9 a.m. And we'll do the same thing again. We'll go around the table, all 19 of us, and talk about what is our view on what the information we said yesterday on the fundamentals of the economy means for policy. And so everyone will go around, we'll vote on the policy options. So there are 12 of the 19 participants who are voting members of the committee, and so those 12 will vote on the decision. We usually wrap up around, 10:30 in the morning. The release is public at 2. The press starts coming in somewhere between 11 and 11:30. They get an embargoed release so they can get their stories ready. And then they'll have the press conference with the chair at 2:30. So
behind the veil?
That's the whole process.
I don't know how many people have read those transcripts, but now maybe AI can
Not
help
many.
us a little bit.
Not many. I mean, if there's helpful things, because you can see the actual words of deliberations. So sometimes, like around the coming out of the 2008 or 2020 deliberations, those can be sort of interesting insights.
Absolutely. Well, one of the things, I mean, if we can for a moment kind of think about the here and now, and you mentioned data and the amazing data the Fed has. I've told many people in the room, I went to grad school because I wanted to work at the Fed. That's why I went and got my PhD in economics and a minor in finance. And I've always been jealous of the data the Fed has. But what I'm curious about is, you know, we've had a couple of months where certain official government sources have not released data. And I was curious if that at all hamstrings the Fed team, or do you have so many other data sources that, you know, that official channel is not really that consequential? So I'll just leave it at that. Like, are you hamstrung at all by some of what's happened at the federal level in terms of less data?
Well, more data is always better.
Yeah.
We're always looking for as much information as we possibly can find, and then trying to separate the signal from the noise. And so not having that BLS data, which is really the gold standard of data, certainly has been a factor in, you know, we've talked a little bit about, like, there's a little bit of a fog in how we're seeing things now, and part of that is that we don't have as much data as we typically would. Having, as you know, being a PhD economist, having long series that are stable and similar is much more valuable than having new things that come in, because you just can't contextualize them. You don't get quite as much insight as to what those correlations look like over time. So it certainly has been made the job more challenging, but we do have lots of other sources of data that we look at. And so particularly on the labor side, there's a lot of data that we can use to see how things are progressing. So we look at the JOLTS data, we look at the state weekly unemployment numbers, the unemployment claims that come out. We look at the WARN notices. Our staff in Cleveland really unpacks those mass layoff notices that come out to see, is there a signal, are things trending in one or a different direction. On the price side of the ledger, on the inflation side, it's a little bit more challenging to get data. There aren't quite as many reliable sources, but you know, we'll talk with businesses and understand how they're thinking about their pricing power. We get spending data. We talk to different credit card companies and understand what they're seeing in their data, which gives us sort of an aggregate view of kind of how spending and consumption might be trending. So we have a lot of places we can look, but we are very grateful that over the next 3 weeks we'll be getting a lot of data, more than 3 weeks worth of data in that time, which will help give us better visibility as to how the economy has been trending.
Great. Well, I know the other issue that's been in the news is about kind of the pressures that get put on the Fed by any kind of political administration. This is not new. It's happened for decades upon decades, and this administration certainly also puts pressure on the Fed to move in one direction or the other. Does that affect the conversations at all within the FOMC, or is it just, you know, like we have our blinders on, data, and what are we going to do 6 months, 12 months, 18 months?
Yeah, I mean, having an independent central bank, if you look across the globe, you see that economies that have independent central banks are able to sustain better employment and inflation outcomes over the medium and longer term. It allows you to make decisions without thinking about short-term political pressures. And that's really the job, that's the goal, is to make sure that when we walk in the room, we're focused on the data, we're focused on the stories and the experiences of the people across the country, and making sure that we're setting policy for that. And so, you know, there is certainly a lot of noise. I think there are things that are happening right now that are completely normal, having the president or other senior officials talk about their views on the economy, what should happen with rate policy. That happens all the time. You know, the president in August appointed a new governor. That's a standard process. That happens all the time. But there are some things that are different that we hadn't seen before. You know, the new governor maintaining his position and affiliation with a different part of the government, that's something novel that we hadn't seen. And the president trying to fire a sitting governor, that's something that we hadn't seen. So we take all of this in stride. The important thing is that when we walk in the room, when I walk in the room, that I'm squarely focused on the data, I'm squarely focused on the experience of the people in the district and across the country to make sure that we are setting policy so that we can have an economy that's continuing to grow and perform.
So I have a couple more questions. Those of you who have questions in the audience, please get ready. We have two of our students who are going to be carrying mics around, so you can flag them down even now. But I wondered if we could move from the national to the local. When I've looked at some of the data over the last 6 months, it seems like District 4 is doing pretty well relative to some of our other partner districts around the country. Why do you think that is? And what can we do in District 4 to sustain kind of our regional economic development?
One of the things I love about the 4th District is it's really a microcosm of the country. If you look at the sectors that we have represented here, we kind of are a really nice mini view of what's going on all across the US. So we've got eds and meds, we've got great universities like UC and others, we've got great healthcare centers, and that's a big component of the economy. We've got agriculture, we've got the rural sectors of the economy, we've got energy production, particularly in Southeast Ohio, we have a lot of that. You've got good manufacturing, a lot of that in the Northeast part of it, part of the region. And you have this transition from manufacturing to the services sectors. You also have the booming technology place, and we've got focus on data centers and AI and all these other things. So you really have a nice picture of what's going on across the country within just the 4th District. One of the things that has always struck me since coming to the region is just how well the private sector, the government sector, and the nonprofit sector really work together. And one of the things that I find striking, whether it's Cleveland, Cincinnati, Toledo, Akron, Columbus, Pittsburgh, wherever you are, what I find is people who are really committed to their cities and who are really committed to ensuring that their cities are as vibrant and growing as they can possibly be. And so that's taking some of the real estate sectors, the real estate team to look at development. How can we bring in more housing? How can we help find affordable housing? How can we create new districts where young people will want to be? How do we get the recent college graduates to want to stay in Ohio to help join the workforce? Because the 4th District overall is the biggest challenge is really demographics. We don't have that many new people moving into the region, and we have an aging population. The bright spots are certainly Cincinnati and Columbus, where we see more growth than in other parts of the district, but that's a pretty consistent challenge that I hear across the region.
Yeah, so you were in New York for more than 20 years. I was in Los Angeles for more than 20 years. So when I first came to Cincinnati, I was like, well, one thing I'm not going to have to worry about is affordable housing issues.
Yes.
So I come and all of a sudden it's like, oh my gosh, affordable housing, this is the biggest issue we've ever faced, and I was like, say what?
Right.
Coming from those coastal regions which have suffered for decades because of, in some cases, maybe less than stellar policy and so forth. So now it's upon us here in these higher growth places like Cincinnati, Columbus. Now we have less affordability than we did before the pandemic. What do you think we can do collectively as a region, given the data that you've looked at and given the partners that you've talked to, that can help facilitate a region that was relatively affordable, can maintain that affordability and yet still grow effectively?
I mean, so we do talk about the affordability issues, and it's true certainly in housing and in other parts of the economy as well. I mean, what I'll say is that even though prices have risen here more than the national average, on an absolute basis, Cincinnati still is a reasonably affordable place to be, and there's a great quality of life here. And so I still think that it will be a place that's able to attract and retain people to come live and work in this area. But when I'm out traveling the district, when I was in Columbus a few months ago, we were sitting down talking with construction companies and builders and trying to understand what are some of the impediments. Now, not all of them are things the Fed can fix. Interest rates is certainly one component of that, and we do have some control over that. Although we control the very front end of the interest rate market, which is not really what mortgage rates are driven off of. They're driven more off the 10-year rate, and so those two things can move differently at times. But that is a place that we watch to understand. When I was there in Columbus talking with some of these builders, they expressed that while interest rates are one component that's been inhibiting some of the investment and growth, the price of materials and labor and the fact that those have risen so much in the past couple of years, that's also been an inhibitor to growth. As we talked about, the labor supply is a real issue in this region, particularly in building and in the skilled trades. Finding people who can do, putting up sheetrock, plumbing, HVAC, all of that is a challenging issue. And so my team has spent time in our community development work. We spend time thinking about workforce development. What are some of the training programs that help to make sure that you get people in those right jobs? And so thinking about, is college a place where everyone needs to go? How do we think about technical schools and high schools and other partnerships, whether it's in the construction or whether it's in, I see a lot of programs at community colleges. We were touring Lorain County Community College up in Northeast Ohio. And they have a couple great programs that help train people for medical professions. So whether it's nursing or other healthcare technicians, and they also have clean rooms. So they've been trying to get people ready for chip manufacturing. And so I imagine that we can look at some of those programs. I'd say fiscal and government policy is better suited to putting in place those types of programs. Monetary policy is a pretty limited, blunt tool. But we do try to study what's happening in those different areas and try to put out ideas about where we see success and where we see promising things to inform the policymakers about how they may want to shift policy.
I have one more follow-up, and then I'll go to the room. You were the co-lead of global capital at Goldman, and so you were in the city where the center of global capital flows. One of the things that I haven't been able to myself look at data for, but I imagine that we've probably seen shifts in District 4. Like, what is the impact of global capital flows now in regions like District 4 in comparison to the New Yorks and LAs of the world?
This year has been a really interesting year in terms of global capital flows. I think it was pretty well documented in the beginning of the year that the dollar weakened relative to other currencies. And I think what that really was, from the conversations that I'd had with market participants, was not so much people leaving the dollar as most international investors had been very overweight dollar assets, and so it was really just shifting to be a little bit more in line. So it wasn't moving away from the dollar, it was just shifting to be more in line. All of the different regions that I travel and spend time with, whether it's the Chamber of Commerce here, the Greater Cleveland Partnership, they're all working to bring more international businesses to their hometowns, to the region, to show growth and to to help show what a great place it can be to invest and live and work. And I think that's been successful. I think early in the year there was maybe more resistance to international companies coming to the U.S. and to really setting a footprint. But I think we've seen some breakthroughs in terms of new businesses coming in and developing.
Good to hear. All right, questions from the room. Up front here, we have a question from one of our students.
Good morning, thank you for coming.
And please introduce yourself, yes.
My name is Hernando Aparicio, I'm from Colombia. And with the new Fed chair coming next year, probably Kevin Hassett, how do you think that's going to affect rates and balance sheet expansion or contraction? And the new Fed, and do you think the Fed will have a new inflation target of around 3%, seeing that it's been sticking in the high twos for now a while?
So our inflation target is 2%. That was created in 2012 as part of our consensus framework, and that's something that I am committed to, and I think you probably heard the Chair Powell say that he was committed to as well. As I mentioned, inflation has been too high, and it's been pretty stable. It ticked up a little bit, but it's been really kind of stuck closer to 3 than 2. It is our job and our responsibility to get it down towards 2%, and I'm committed to doing that. It is challenging right now for monetary policy because we're being challenged on both sides of the mandate. So inflation has been too high and it's been holding there at those levels for some time, but we are seeing some softening on the labor side of the economy. I know that as college students and as hopefully soon to be graduates, there's a lot of focus about how hard it's been for, I think, some recent graduates to find opportunities and to find new jobs. We are looking closely at the labor market to understand how much of this is secular, how much of this is driven by some of the automation, NAI, and other changes, and how much of this is cyclical. Our monetary policy tools are really well suited for handling cyclical changes. They're less good at handling structural changes. So if this is really a structural change that we're seeing in the economy, that's something that fiscal policy or elected officials are going to be better set up to manage. But I am truly committed to the 2% objective. I think it's critically important that we do bring inflation back down towards our target. I have every confidence that a new chair coming in will also be focused on a 2% inflation objective. And really right now, the challenge is in balancing both sides of our mandate. And so we want to make sure that we're supporting that maximum employment alongside that price stability. And to me, one of the reasons why price stability is so critical is that if you have price stability over the medium and longer term, that will support better job growth. Having stable prices means that businesses and households can plan better for their futures. They can think about where they want to invest, where they want to grow. They have more certainty about what their dollars today are going to be worth tomorrow. And so it's critically important that we do that to support the labor side of our mandate.
Great, thank you.
Thank you.
How about this side of the room? Questions? I always want to be fair to both sides of the room. How about this side over here? Other questions? All right, we have a question up here. Pam Weber. Well, it's for the recording and the live stream and all of this, so we do need the microphone, but we can't hear you otherwise.
Pam Weber with PNC Bank. We hear a lot in the media every day. We deal with it every day, that being AI. Heard you speak a lot about the data that you deal with day to day. How has AI changed the way you do your job, and how do you see it continuing to change the way you do your job?
And of course, if the Fed can tell us what AI is going to affect the economy 12 months from now, then we're all ears.
Yeah, well, if we had a crystal ball that gave us all the answers,
Yes.
we'd be much better at this. But unfortunately, no one has that crystal ball. Maybe AI one day will get us there to give us perfect visibility as to what's going to happen in the economy. But of course, there's always policy changes and environmental factors that change. We've been spending a lot of time studying AI and looking at how it's impacting the economy in different segments. I did a trip out to Pittsburgh where there are a couple of companies who've been really investing in AI technology, partnering with Carnegie Mellon, who's got a center where they've been really spending a lot of time on it as well. And so looking at how different companies are using it, it's almost impossible to do a meeting with a business and not have AI come up, not talk about how it's transforming things. At the Federal Reserve, we do have an AI instance that I'm proud to say was created by the Cleveland Bank that is available for people to use. Now, of course, given the sensitivity of the data that we use, it's really meant to be used, it's an internal instance, but on public or non-restricted data. So we can't really put all of our great FOMC observations and data into it just yet because it's not public and you wouldn't want to give it that type of information. And as a central bank, we tend to move more slowly than the private sector, which I think you would want us to move more slowly. So we will find efficiencies and we are finding uses for it. But I think we're going to probably be a second or third mover, not a first mover in some of these innovations. So for us, it's really been studying how other companies are using it, trying to get insights for where it's been beneficial to them, and then really understanding how it's shifting the labor market. So I hear a lot when I'm out with businesses about their ability to automate. Again, we've been in this kind of low hiring, low firing labor market for some time now, and what we hear from businesses when we're talking to them is that they've been managing their workforce more through attrition. So as people leave, can they automate those jobs? Can they find different processes that will help to save on those labor costs? And it does seem like some of the AI benefits are coming at those very early stages of work. So whether it's summarizing things, whether it's giving you better insights or tools for a call center, those are the kind of places where we're hearing that it's being used. But then there are other places at the more extreme side which are using agentic AI. So this company that I met with in Pittsburgh, they have digital employees, and so they have have email addresses and they have personalities, and you can interact with them and give them tasks, and they run 24/7, and so that creates a lot of different efficiencies. But what I'm hearing more and more with the businesses that I'm talking to is that sometimes the AI is going to be a replacement for work, but more often than not, it's going to be a complement. It's going to help existing people do their jobs better. When we were down in Cincinnati a couple months ago, we were talking with a healthcare center, and they were saying that they didn't see the AI as giving them, as reducing their workforce. They just saw it as relieving a lot of the physicians from having to do paperwork and to be able to automate some of that so they could spend more time bedside, they could spend more time with the patients, give a better patient experience. But it may give them insights and diagnoses. It may help with filing claims, right? So a big process that hospitals have to go through is they have to, every time they submit a claim, something gets denied, they got to look at it. Was it right for it to be denied? How do we get the reimbursement back? And the AI can help with a lot of that in terms of going through, grabbing the right files, sending it back to the insurance company to make things more efficient. So, like many of these new technologies, these transformative technologies, if you go back and look at whether it's electricity, steam engines, the computer, at the time it happens, they're very disruptive, and people are very concerned about their work and their ability to work. But what you find is there are whole new types of jobs that get created that we didn't even imagine before to help support these tools, to help enhance these tools, and to deliver new things into the into society. And so I'm sure that it will take us some time to figure out what those roles are. But every time we've seen these kinds of transformative technologies, they've helped to move us forward as a society and to provide a better quality of living. And I'm hopeful that AI will be that as well.
Thank you. Yes, question in the back.
I have a question. My name is Monique. I wanted to know if you supported the decision to lower the rates at the last FOMC meeting.
So at this FOMC meeting that we just had a few days ago, I was not a voter. I will start voting again next year. We have a complicated rotation that happens amongst the bank presidents. This was a complicated decision. We'd reduced interest rates by 50 basis points already. As I talked about, we're in this challenging time where we've got pressure on both sides of our mandate. We are seeing some signs of cooling in the labor market. So you're seeing the unemployment rate move up gradually, which is unusual, but it has moved up gradually. You're seeing much lower headline payroll growth than what we've seen historically. Now that could be driven by demand, that businesses want fewer workers, but it could also be driven by supply. We've had a huge shift in terms of the immigration flows. And so the number of new jobs we need to create to keep unemployment stable, I think, is greatly reduced from where it had been in prior years. So in the past couple of years, they've been running in the couple hundred of thousands of jobs that were being created. Over the past 3 months, we've been averaging closer to 60,000 jobs that have been created. And so that's something we need to watch closely. But as we talked about as well, on the other side, inflation has been too high. It's been much closer to 3% than 2%. And so it's a really difficult balance. To me, right now, we've got policy that's right around neutral. It's in that range of neutral. And when we've got challenges on both sides of our mandate, being close to neutral is probably the right place to be. I would prefer to be on a slightly more restrictive stance to help continue to put pressure on that employment side of our mandate, that inflation side of our mandate. But we have to watch on the employment side as well, because I don't want to see further weakening. I don't want more people out of jobs than need to be. That's extremely painful, and that's going to make this affordability crisis even worse if we see unemployment tick up. And so it's a challenging time to look at how we should be positioning policy. But my perspective is that right now, after the 75 basis points of reductions that the committee has taken over the last quarter of this year, we're right around a neutral policy. And I want to be watching carefully as we get this data over the next several months to see, are we seeing inflation start coming down towards our objective? Are we seeing the employment levels stabilize? Those will be key signals to me that we're moving into a place where this can be a policy rate that we can maintain. If I see more pressure coming from inflation side, some of the inflationary pressures that we've seen this year, one of the big debates has been, is inflation right now coming from tariffs? Is it coming from the goods prices? Because goods inflation has been significantly higher than it had been historically. Over the past couple of years, goods inflation has been running negative, negative 0.5%, negative 1%. And more recently, goods inflation has been positive. And so some of that will be from tariffs. But when I'm out meeting with business leaders, I'm also hearing that there are energy prices, that there are insurance costs, that there are labor costs. That's also adding to the inflation picture. So to me, it's not obvious that the inflationary pressures that we've seen are coming just from tariffs, but I think most estimates would say that we should peak, the tariff inflation should peak somewhere in the end of the first quarter. And so if we start to see inflation coming down after that, that would give me confidence that, yeah, maybe this was really coming more from tariffs. If it's sticking around and if it's at these higher levels for a bit longer, then that's going to say to me, maybe we need to look at where we are from a policy perspective. Maybe we're not restrictive enough, assuming the labor market holds up. If the labor market weakens further, then it just gets to be back in this challenging time. So it's a lot to think about. Hopefully AI will be able to help us one day come up with the right answers. But to me, really being out there and talking to individuals and businesses helps to give me an insight. What I find is that these conversations that I have that add to this picture on what's going on in the economy tend to be forward-leaning. And so they tend to be leading indicators of where the economy is going to go. And so that's why I try to rely on them so heavily.
Yeah. Other questions?
Good morning. Warren Weber with PNC. I'm curious, obviously, huge influx in private credit. And while the Fed, I don't think, has direct supervision responsibilities, I'm curious how you think about it as far as systemic risk to the financial system.
Yeah, it's a great question. Private credit is a place where I've been spending time kind of unpacking what's going on. One of the issues is that it's a more opaque sector. We don't have as great visibility, so we do have lots of amazing data, but On private credit, there's not as much there as I think we'd like to see. It is something that's been growing. I think it's a question of, has it been growing because of the banking regulations that were put in place coming out of 2008 and some of the leveraged lending guidelines, which the FDIC and OCC recently revoked. So there could be a shift and there could be more that comes into the banking system. There are some positives to private credit and there are some negatives. The positives are that you do see lots of lending to small and medium-sized businesses, and that has helped to keep the economy growing. And so that's an important source of credit formation. The funds tend to be locked up. So unlike bank deposits where you can have withdrawals, usually private credit has 7 or 10-year fund lives. And so you have good certainty that what they're investing in, those loans that they're making against that funding won't have a run. You won't have that same type of issue. But it is opaque. It tends to be some of the riskier lending that we see. That's part of the reason I think that it's happening in these private credit funds rather than in the banking funds. You do have some private credit that's backed by insurance companies. So there's been this growth in insurance companies linked with private credit lending. Now, some of that is in investment grade sector, but some of it is in the higher yield or leveraged loan space. And so it's a place that I think we need to continue to watch. It's, the growth that we've seen has only really been over the past 5 or 10 years that we've really seen this significant growth in that sector. We are hearing that as companies had gotten challenged over the past couple years, there were more amendments and more extensions. Now that can be a positive, where the company that has this loan that maybe couldn't make these higher interest payments, they're now shifting to payment in kind features. They're using those. Now that helps to give them the ability to keep paying and stay current for longer, which could help keep the company afloat. But if it's a company that's just not have a great business model, it might actually just be delaying the inevitable. And so we do need to watch, could at some point that shift to create a bigger downturn in some of those segments of the economy than you would like to see. The good news is that I don't think private credit is of a size that it would give rise to broader systemic issues. But a lot of the investors are, in addition to insurance companies, can be pension funds. And so, if we have, even though it's locked up, even though I don't know that it would be systemic, if we have large losses at Ohio Teachers or other pension funds that are invested in this, I'm not going to feel good about that. I don't think any of us should feel good about it. And so it's a good question about, I don't know what the right way is to manage it. I'd just love to have more visibility as to what's going on there, which would help give us insights. And then, of course, there are linkages back to the banking sector. We know that the banks have been growing in their lending to these NDFIs or private credit funds. And so trying to make sure that even though we think it's really outside the banking sector, understanding how much is coming back on and then what that could mean from a systemic perspective is really important.
Yeah, that's great. Yeah, I know we have time for a couple more questions. I have one right here, and then I know I have a question as well on my side.
Dan Johnson, the City of Blue Ash. I'm just curious, so I don't know, I don't recall you said how many districts are around the country, but do you find that the 4th District is most similar to the districts that are geographically closer to us in terms of how you evaluate, whatever it is that you're evaluating, and that the coasts seem to be looking at things differently on a regular basis? Or is it just every district is wildly different and there are no similarities and you don't form blocks when you get to these times that you're actually going to vote on something?
Yeah, I mean, we don't form blocks. Everyone comes in and votes, they're conscious, they vote their view of how things are progressing in their district. One of the nice things about the system is that you do have these 12 regional reserve banks, right? You've got the Board of Governors in Washington, that's 7 governors who are appointed by the president and confirmed by the Senate. You've got these 12 regional reserve banks. Now, it's a little strange, the districts that are set up, because it was created in 1913, and so the districts are reflective of the economy in 1913. So the 12th district, which is the San Fran Bank, has like the entire West Coast, which is about 20% of the U.S. population. And we in Ohio are, I think we're about 5% of the overall population. So it may not be as evenly spread if you were remaking the districts today, but it is really reflective of a number of different geographies. And so you find there are trends and there are differences regionally. So the West Coast is certainly impacted by the tech sector. The Southeast, the Dallas district, spends a lot of time thinking about immigration because they're looking at a lot of the border towns with Texas. The energy sector they spend a lot of time on. You've seen this migration into the Southeast, so whether it's Dallas or the Atlanta Bank, they're seeing certainly effects of that. whereas some of the northern districts, whether it's Cleveland, Chicago, Minneapolis, those would have, I think, some more of the demographic challenges that are similar to what we're experiencing here. The good news is that the whole system is accountable to Congress and accountable to the public. The chair of the Federal Reserve, Chair Powell, testifies in front of Congress twice a year to talk about what we're doing, how we're seeing the economy. And part of our goal, part of my role as a Fed president, is to be out there talking to people, not just to get information about the economy, but to offer insights that we have and to hear feedback about how we're doing. And so it's events like this where I get to hear firsthand things that you're concerned about that help inform kind of my perspective and how we should be shifting things. So there are some differences regionally in terms of how we're set up, but we are setting now national rate policy. Back in the beginning, I think different banks could have different discount rates. That's no longer the case. We have one uniform rate across the country, which makes sense given how capital flows now. So we want to be attentive to some of those regional differences, but we do want to set policy that's going to work for the overall 50 states.
Great, thank you. Question?
Hey, Lee Kander here, UC student. I think we have a decent amount of students in the room here that are looking for internships and jobs, and I was just kind of wondering how you think students should approach trying to secure full-time jobs in a soft labor market.
So I think a lot about this because I've got two 20-year-old sons who will soon be looking for jobs themselves. So what I find is a great opportunity are events like this where you can network with business leaders. So I'm a little bit saddened to see so many students sitting all together, which I know makes it significantly more fun. But this is a great time. Instead of having fun with your peers, it's a great time to be out networking with all these business leaders in the room who hopefully are going to be people who could be offering internships and opportunities. And so I think that's one of the great ways to do it. I would say be curious, be out there. I have heard we had a big convening in June called our Policy Summit in Cleveland. And we did hear from some students and others that right now applying for jobs feels kind of like you're going into a black hole because it's so easy to click and email things that you can apply to 100 jobs, but you send out 100 resumes and you get no responses because the companies are now getting deluged with these resumes that it's hard. So you have to find some way to make yourself stand out. I think having some personal connection, knowing someone on the inside, having some demonstrated interest where you've really shown that you care about that company, you care about that business, that will always help, I think, in terms of getting your foot in the door to start things. So I just encourage you to continue, building these relationships. Come to events like this where you can hopefully help to find more opportunities and connect with people.
And of course, when our UC real estate team, whether it's Heather, Carl, or I say it, it is probably not as impactful as when our president says it. Networking is the key, so we really appreciate that. I did have one more question just on my side, kind of as a representative of the university. I've had the opportunity to connect a little bit with Julianne and Robert in the Cincinnati branch. Whether have my just UC real estate hat on, or Lindner College of Business hat, or some of our, connecting to our existing centers on data analytics, or some of our new work in social innovation. We want to know how can we partner to make your work more effective and the work that you care about in creating an economy that works for all.
Yeah, we appreciate all the partnerships that we have, and it's been great to get to know people here, get to know people at UC. And we do have a team here. Most of our Fed team is sitting here, so we've got Julianne, who's our lead, our regional executive for the Cincinnati office. She spends a lot of time out in the branch. She's part of our economic research team. We also have Courtney Filato, who is from our external engagement function, Robert Brinkley and Doug Campbell. So that's the team that we brought with us today. They're all here to help connect and get insights as to what's going on. We would welcome suggestions. We have a team of 75 economic PhDs who are thinking about different problems in the economy. They want to partner with different organizations to get better data, get better insights, hear what are those problems that communities are experiencing, help study them and provide analysis out there. We have a huge amount of research and data available on our website, clevelandfed.org. I mentioned the Center for Inflation Research. And so we have a lot that I think individuals can look at. And we've done some studies about things on a more local basis. So when there was that huge flooding in eastern Kentucky, the team did some work to understand how was recovery happening there, what resources were needed, what helped certain regions to recover faster than others. The team's recently done some work around housing conversions. And I know we're sitting in a building of a giant office to housing conversion, or partly that at least. And so I think this is another area that we're seeing some shift in. So just continuing to study and work together on where you're seeing interesting opportunities. And our researchers, will partner with people, as is very common in the research practice. Yeah. Nobody does anything alone. There are a lot of partnerships with people outside the Fed, and so it's going to be a great opportunity for us to learn.
Wonderful, wonderful. One last question over here.
Mike Hallinan with Edge Real Estate Group. Consumer sentiment. It seems as if these days we hear, especially among popular business media, that so much emphasis is being put on consumer sentiment as a barometer of how the economy is going as a whole. It strikes me that that's much more anecdotal, and given how quantitative the Fed is, do you talk about consumer sentiment? And if not, why should the rest of us?
It's a great question. I do look at consumer sentiment. It doesn't tend to correlate very well with spending data or GDP data. And so I look at it and I think about it because it could shift individual behaviors. But generally speaking, it's not one of the stronger indicators. So I put a lower weight on that than I put on a lot of the other official data. There's a lot of talk about this vibes economy and how people are feeling around things. And some of that, will play through over time, but some of it won't. And so it's important to understand, if you look back at the data in April when the tariffs were first announced, they were so significant. You saw a huge step back. And I think what was really driving things then was more uncertainty than anything else. I think business leaders just didn't know how things were going to play out. We've seen a lot of uncertainty all year that's been continuing to persist, and that tends to have a cooling effect on the economy. The bill that was passed, the fiscal bill that was passed over the summertime is going to put a decent amount of stimulus next year. There'll be a decent boost to the economy coming from that. And so, the sentiment numbers can be a useful indicator, but I give them a pretty low weight in my overall picture of things, just because they haven't historically correlated with some of these other things. And so again, trying to look forward as to where the numbers are going to head, what's GDP growth going to look like, are businesses going to be out there hiring, or do they need more people? We've been hearing for a long time that they've been trying to not pass on the full impact of tariffs or other input cost increases. I don't know that can last forever. We hear from a lot of businesses in the district that January is a time when contracts get renegotiated and that there could be more price increases coming. And so that's something that we're trying to be attentive to. But as we talked about with the new data, or the old data coming back over the next several weeks before our January meeting, which is at the end of the month, we'll have a lot more information that'll help give us, I think, a lot more clarity on how the economy is performing.
Well, let me just conclude by expressing my thanks on behalf of everyone here. It was so great to have our president here. Beth, we really appreciate the time you've given to all of us, and we hope, again, that we can continue to partner to help our economy work for all.
Well, thank you so much for having me. This was really great.
Thank you so much.
Thanks, Dave.
You want any last words?
Thank you, everyone, once again for attending. Just a couple of quick cleanup items. Thanks to Doug Campbell and his team for all your help in organizing this. Thanks to Don Vonderhaar and his team here at the Immersive. Love the graphics. Can we get a little bigger sign next year, maybe? Next month, January, we will be back at Blue Ash at Cooper Creek hearing about economic development associated with the Crown Trail project here in Cincinnati. And then February, Stu Hoffman and Greg Valliere make their triumphant return to Cincinnati for the 32nd version of the UC PNC Economic Outlook, which will be held at the soon-to-be-open Duke Convention Center about 4 blocks that way. So we're looking forward to that. If we can have our students migrate up to the front here for a little photo op, that would be great. And everybody have a wonderful holiday, and we will see you in 2026. Bye.